Kotak Mahindra Bank is the top Nifty loser, now down 4% as Joint Managing Director KVS Manian announces his resignation after nearly 30 years at the bank. Brokerages issue largely negative reports on the stock. Jefferies maintains a hold call while Nuvama downgrades the stock, cuts target price.
Automakers report a mixed bag for this month of April. Sales disappoint for Maruti Suzuki, while Tata Motors zooms as commercial vehicle sales remain strong. TVS Motor rallies on 25% sales growth, while Bajaj Auto to remain strong.
Oil marketing companies, all of them higher by anywhere between 2 to 5% as crude prices correct over the last 2 days, trading closer to $84 per barrel.
Godrej Aggregate climbs more than 2%, while Godrej Properties slips nearly 3% following the announcement of the amicable separation of the Godrej family into two factions, Godrej Industries and Godrej Enterprises.
And IndiaMart and Chola Investments climb more than 4% each on the back of good numbers coming in for both these companies.
Hello and welcome to Chartbusters. I'm Naishra D'Souza. Joining me as always is Mangalam Malu, and we've come back post a holiday and it seems the bulls are recharged. Remember, in Tuesday's trading session we ended virtually at the low point of the day, but today as we speak we're up at the high point of the day on the Nifty, Sensex, Nifty Bank and the mid-cap index doing well. So good rest, Mangalam, and the batsmen have come back out.
Good rest, some cold towel treatment after the volatility that we saw on Wednesday. Let's see what the second half holds for us also, because it's the Nifty weekly options expiry, so we'll keep an eye out on that. But the good part is today's lows have been bought into. We're at the high point of trade for the frontline indices, and we are seeing some traction come back in the Nifty Bank despite a 4% fall in Kotak Mahindra Bank as well. Let's talk about our special segment which gets you ideas for profit from our colleagues from Money Control Pro, and today we have Bharat joining in with the stock that he's been tracking. Bharat.
Today's ideas will be Indian Hotels Company Limited. The company posted its best ever quarter 4 performance in the fiscal gone by. Consolidated revenues grew by 17% YOY. The domestic business RevPAR grew by 14%, whereas the international RevPAR grew by 2%. The operating margins improved by about 200 basis points, driven by lower employee and F&B expenses. The demand momentum continues to remain strong, and the company expects the double-digit growth momentum to sustain going ahead. The company has lined up aggressive room addition plans and aims to add about 13,000 rooms over the next 4 years. About 80% of the incremental room addition will be via the asset-light management contract route. The company also aims to launch the Gateway brand, which will be positioned as a full-service 4-star brand. The new businesses of Indian Hotels Company continue to ramp up significantly. Additionally, the company is sitting on cash surplus of about 2,000 crore rupees, which would enable the company to tap inorganic growth opportunities and accelerate the growth momentum going ahead. The hotel industry upcycle is expected to sustain over the next few years. Indian Hotel Companies is amongst the best hotel stocks to play the industry upcycle. At the current market price, the stock is trading at an EV by EBITDA of 27 times FY26 projections. Investors can add the stock in the book. Thank you.
Thanks a lot for that, Bharat. Well, for the time being, though, before we get to that chat with the management of Havells, just pull up MOIL. MOIL has moved to the high point of the day. We here at CNBC-TV18 had alerted you all close to 8 sessions or so ago that, in fact, there is a global glut in terms of manganese ore, and manganese ore prices were surging up. What happened on Tuesday night was that the management has come out and said, yes, we're going ahead. We're increasing manganese ore prices by 25 to around 40%. The key reason is there's an Australian mine that has faced some issues. Because of that, close to 10% of the global supply has gone out of whack. And that's why some of these manganese ore producers are enjoying globally. And MOIL as well is participating in that, up 8%.
All right, Nigel, that's about MOIL. But let's talk about Havells India. The company reported their fourth quarter numbers. It was above estimates, and that's largely because of margin improvement. Also, a turnaround that we saw in their Lloyd's business. So we have with us, the chairman and managing director of Havells, joining in, Anil Rai Gupta. Thanks a lot, Mr. Gupta, for joining in. It's been a strong end for the year. Revenue growth in FY24 was close to around 10%, but much lower than what we saw in the previous couple of years as well. What's the target for FY25 with regards to the consumer sentiment that you've seen and the revenue outlook that you can provide?
So I believe, yes, you're right. The growth has been tepid in FY24 overall. But what is positive is that we've seen some improvement in the second half of the year, especially the fourth quarter. And that brings in confidence that FY25 should be a better growth year for the organization as well as for the industry. You know, in the last year, if you see the industrial and infrastructure segment, which is cables, professional luminaires, industrial switchgear, that was doing all right. But the real estate demand, the consumer demand was not really up to mark. And we do believe that it has started showing positive signs in the fourth quarter, which also augurs well for the coming year. I think also the summer season has started off well for summer seasonality products like air conditioners, air coolers, fans, which again should give us good growth. And if the consumer demand continues to hold, that will be meaning good for the organization.
All right. Well, the other question I wanted to ask you, sir, is your EBITDA margins in quarter 4. Well, they've recovered to double digits. This after 3 consecutive quarters of high single-digit margins. The question is this improvement sustainable? Because commodity prices, copper, they have climbed to multi-highs. You also have plans to manage your margins as well as market share. Since you also mentioned price hikes will be taken.
Trend of the raw material in the coming months, we will be taking certain decisions. When the EBITDA margins are actually going up, it's actually coming back to more normalized levels for the company. It had slipped because we were making huge investments in Lloyd for brand building and product and market share. So I think overall now Lloyd has also reached a certain good market share. And we'll continue to focus on investment in Lloyd for growth, profit, and market share. So I think all these things mean that we are looking at better margins for the company as a whole.
All right. So with the investment that you said on Lloyd, etc., is there a range, the guidance that you can give for FY25 in margins?
Usually, with all the investments going on at Havells standalone without Lloyd, we try and look at between 13 to 14.5%, somewhere in between these kind of levels.
Let's talk a little bit more about Lloyd's because that's the swing factor, right? It's turned into the green, which is good news. Now, given that we are experiencing a very, very hot summer, it bodes well for demand perspective as well. So what are your growth, volume, pricing expectations for Lloyd?
Yeah, I think, again, as I said, we should not look at one quarter. We have to look at, this is a seasonal quarter where the seasonality demand is better. First quarter is also similar. So we have to look at the overall year. And as I said, Lloyd has a lot of actions, including investments, but also cost efficiencies, pricing actions in the market. As you said, it's a good growth because of the good summer. But, the volatility in the raw materials can augur some price increases in the coming times. So all these actions put together, we will have to see how Lloyd pans out. But we are quite hopeful that things are on the positive side.
What about the ECD segment? I mean, that was muted until now. Now has seen a bit of a pickup again by summer demand. What's the expectation here?
I think last 1.5 years, there was volatility in the growth in ECD segment, also because of the transition to the new BEE norms and fans. But that is now stabilized and which has brought back growth. In fact, albeit over a soft base of last year. But we are seeing good traction. Summer, as you said, is a good summer, so which will mean good growth for fans. So this year, we are definitely expecting a much better performance from ECD segment, even on the margins front in FY25.
All right. Well, your kitchen appliances launch is scheduled this month, I believe. What would be the incremental revenue expect from there? Since you'll be outsourcing it, how will the contribution to the margin profile look like? And any plans to scale this up, basically?
Consumer durable category, we have a business unit, which is small domestic appliances, which includes mixer grinders, blenders, toasters. So we are already in the kitchen for the consumer. And this is a product addition into that segment, which is kitchen chimneys and hobs. And we do believe we have the brand affinity as well as the channel affinity towards these product categories. So it was a natural entry for us into this product category, and that will add to the top line for our small domestic appliances business. So overall, we do believe in the next 3 to 5 years, we should be targeting good, meaningful market shares in this segment as well.
What about lighting and fixtures? I mean, a high contribution margin business, but saw some pricing aggression earlier. So is the pricing aggression behind you? What's the volume growth here and the outlook for FY25?
Well, overall, lighting, we have been delivering a very satisfying performance because despite the fact that there is price erosion in this business, the volume growth has been healthy. And we are also growing very well in the professional lighting segment. So the company's focus, as you said, it is a higher margin business, is more on innovation and product, and rather than just doing mass lighting kind of projects. So this is something which has been a strategy, and we expect that given the fact that the price erosion may be at towards the more on the ending side. So I think decent volume growth should start picking up from now on.
Okay. Give us a sense about the capex plan. I think last year it was around 780 crores. You've also announced 800 crores for FY25, which will be focused on cables and wires. What is the incremental capacity you plan to add? And by when would some of these capacities come on stream and start contributing in terms of revenues?
Well, this is a combination of many businesses of Havells, not Lloyd, because Lloyd, the capex was done over the last 2 or 3 years. But most of the other Havells businesses would be doing some capex this year to enhance capacities, to balance lines, for a new facility at Tumkur, which is now going to start production. So this is for each product category. And so it's difficult to say, what is the capacity addition, but in every product category, there will be capacity addition. This is to take care of the future growth needs for the organization.
All right. And what about your return on capital employed? That's improved to almost 25%. You said, in terms of growth margins and capex, given us some idea of where we're headed. What about ROCE?
As a business, we'll continue to grow the business and the margins of the business, and be very I would say conservative on capital allocation, which we have done over the past, and these are the levels of ROCs that we'll continue to strive for.
Just to confirm, you're saying ROCE will be maintained at around 25%?
Yeah, there is a range between 20 and 30%, and that's what we usually try and strive for.
All right. And about 3,000 crores cash on books. I mean, how much of that will be used into capex? How much do you plan to, use for inorganic or maybe some sort of shareholder returns here?
Well, I think the company has been doing good capex over the last few years. And, given the fact that we acquired Lloyd and then added capacities there. So a good amount of cash gets used in internal capacity additions, giving back to the shareholders as well. So I think we are using this cash quite prudently, and we'll continue to do so in the future.
Always good speaking to you, sir. And it's good news that finally Lloyd's has turned around. We'll hold you to some of these numbers, but it's scorching hot. So in fact, it looks like part of your products will find good amount of demand. For the time being, though, we'll slip into a short break. On the other side, we'll be joined by the management of Eveready Industries to discuss the quarter gone by. You don't go anywhere. Welcome back. Well, the stock that's not moved much actually is Eveready Industries. They came out with a set of numbers a few sessions ago. FY24 saw improvement in margins. The top line growth has not yet come about. To understand what's the outlook from here on, we're joined by Mr. Saha, the managing director of the company. Hi, Mr. Saha. Good to have you on the show after quite a while. Well, that margins that you had given us that guidance of, I think, 10 to 12%, you're pretty much on course with regard to that because you achieved it in the past fiscal. What about revenue growth? That's still missing. I know commodity prices have moved a fair bit. So tell us, what kind of consolidated revenue growth should we be looking at for FY25? And what's the outlook of margins? If you could fill us in with these numbers, and then we'll get into the qualitative aspects as well.
Okay, thank you. Thank you so much for having me on your show. So FY24, we did, I would say, robust profitability. The top line, as you very rightly mentioned, was muted. It was primarily due to two external factors. One was a serious value erosion in the lighting segment, which was an industry-wide phenomenon. It was nothing because manufacturing efficiencies were passed on to the market by all players, and we also had to do the same. And also weak rural demand, which impacted our battery and flashlight revenues. So we ended up on a flat note. However, from here onwards, the way we see it is that that value erosion has by and large leveled off. And we feel that, from second quarter onwards, and that is an estimate, the demand part of it would also show improvement. So, going forward, our understanding is that we should be able to grow our battery business at 5%, the flashlight between 10 and 12%, and the lighting at 20%, giving a consolidated growth with these three categories at around high single digit. If you are lucky, maybe 10% plus.
Okay, just to confirm that, sir, battery 5%, flashlight 10%, and lighting would be 20%. We got that correct?
That's right.
So hopefully you grow by 10%. That's the endeavor as of now. First quarter could be a little soft because of elections prevailing in various parts of the country as well. But what about margins? You've done well in terms of margins. Where is it headed?
So, we have a bit of challenge in terms of, commodity prices,
Yes.
heading northwards. However, we are very confident that we would be able to improve our margins from what we achieved in FY24. So we are holding on to our guidance that our margin would be, certainly between 10 and 12% at the EBITDA level, which would be better than the 10.8% that we notched in FY24.
All right, margins between 10 to 12% for the last year. Next year, mild improvement over the last year. One is, expecting the revenue growth to come about for not just your products, but the entire consumer industry itself. I just wanted your thoughts on, the new category that you were seeding for growth. Something that you spoke about as, a deliverer of almost 500 to 600 crores in revenue. What is this category that you're eyeing right now?
So, it is like this, that we have given a guidance to the market that we should be able to double our turnover within say a 3 or 4 years period of time.
Yes.
For that, the three categories that we already have would go somewhere, but we need a contribution for a fourth or a fifth category. Now, we can sort of set upon identifying that category around this time. Unfortunately, due to, because of the muted top line that we had, we have just deferred that by 1 year, that goalpost by 1 year. So we remain directionally on the same path, only the goalpost having shifted by 1 year. Hence, I am unable to tell you today, what exactly would be the shape and size of that category. And I think we would be working on it in the course of the next 12 months or so.
So if we were to look at your FY27 revenues, which you're talking about, say about 2,400 crores, your organic business would be close to around 1,800 to 1,900 crores with 500 to 600 crore coming in from that existing, the new category, right?
That's a very correct observation.
And the new category, would it be in conjunction with the places that you're already in, or would that be something entirely new? Because, I mean, if it is totally different, then the supply chain would have to be changed as well.
So directionally, our first preference would be to sort of take on something that takes our brand and distribution, our strength areas. However, this is something that we need to figure out because, everything may not be so ideal that, we would get the best fit for both brand and distribution. We'll have to see how it gets going.
Is there a possibility that the new category could also come in the form of an inorganic opportunity?
Yeah, we don't rule that out.
Oh, interesting. So, but are you speaking to players?
No, we have not yet. As I said, we would start this endeavor, once we have consolidated our current businesses, because, we had a little bit of a, sort of, less than expectation with our top line in the last financial year. So we want to consolidate and then take on any.
Okay, could it be a possibility that it will be something related to EV? You've explained this to me in the past. The current business has nothing to do with electric vehicle besides it having battery in common. But the new business, could it have something in that direction?
See, that's the most exciting part of, battery business that's happening. So, it's very early days for me to make any speculation on that.
But if you're doing some inorganic growth, it could be into electric vehicles. Is that a possibility now?
Electric vehicles? No.
Not at all.
No. Vehicles is far apart.
So nothing in that direction with regard to batteries for electric vehicles.
Oh, you mean batteries for?
Yes.
Okay. So, as I said, that's an exciting part of, the battery industry. So one cannot be completely blind to that, but these are early days. It is too difficult to sort of speculate on this at this point of time.
All right. And you did not rule out the possibility of an acquisition at some point in time. We'll let that be as it is. What about your balance sheet right now? I mean, can your balance sheet, support something? What's the debt reduction plan? You've reduced it by a bit. What does it stand at now, and what should it be by the end of this year?
We did reduce debt quite significantly during this year, primarily for operating cash accruals. The debt currently stands at around 280 crores, and we are quite confident that this is not something that is really, keeping us awake at night.
Okay, and any update with regard to that KKR arbitration case? Any update?
So, as per the arbitration panel, the final date for hearing has been set sometime in July. So we are quite hopeful that the company would sort of, as it has maintained its stand, that it has really nothing to do with the situation, and we are hopeful of a positive outcome.
Okay, so we'll wait for that final outcome then. Thanks so much, Mr. Saha, for joining in. The stock price move hasn't been very, very exciting, but you have exciting plans. So let's see how you go about business. For the time being, we slip in a short break. Continue our focus on markets on the other side. Welcome back. Well, the Nifty is still trading in the green, but the Nifty Bank, well, that's the one that's trading as flat as can be. A few minutes ago, it was in the red as well. We have run out of time on this edition of Chartbusters, but you don't go anywhere. The team of Trading Hour will take the action forward.